Hello everyone, and welcome again to Saxo's Macro Insights channel, which aims to bring you a variety of perspectives to help you with your trading and investment journeys. I am Charu Chanana, a market strategist with Saxo Singapore, and in this video today, we will talk about the potential threat of inflation coming back later in 2023, especially underpinned by China's reopening, which has been much faster than expected. So until recently, we actually had markets taking a lot of comfort with the global inflation picture, with US and Eurozone inflation prints turning lower. But as you can see in these charts here, of late, we've had Australia and New Zealand CPI out for Q4, and these served as a stern reminder that inflation is unlikely to move down in a straight line. We had Australia's CPI showing inflation rising to a fresh 33-year high in the fourth quarter at 7.8% year on year, as you can see on the left chart. And New Zealand's was somewhat softer at 7.2% on the year for Q4, but still pretty firm and close to a three-decade high of 7.5%. I think these numbers serve as a reality check for all that peak inflation, peak interest rate rhetoric that we've heard for some time now. I mean, granted, we do have supply chain pressures easing and world container rates are dropping, so that is deflationary. But there are several factors that support our cautiousness on that peak inflation rhetoric. For once, of course, as you've seen since the start of the year, we have had the soft landing narrative pick up traction relative to a long and deep recession that some were looking out for at the end of last year, mostly because Eurozone is kind of avoiding a recession right now. And of course, because of that China pivot that we've got as well. But with that soft landing narrative picking up, that also means that consumption demand would not contract as much as previously feared, which again raises some inflation concerns. Secondly, and more importantly, I think it's important to highlight here that China's reopening has already meant a big run higher in many commodity prices. China is the biggest consumer of commodities in the world, as you can see in this chart on the left. Anything from iron ore to aluminium to copper to even crude oil, it depends in large parts on Chinese demand. And now with that faster than expected reopening in China, you can see with the chart on the right where I have taken the example of copper prices particularly, but many other commodities as well, iron ore, WTI, crude, everything's up significantly from its recent lows that were printed, in H2 of last year. So just highlighting here the scale of strength that we are seeing in prices of China-related commodities. And this is purely based on anticipation still. The real impact of reopening will likely flow through after China returns from the Lunar New Year holiday. The other thing to consider here is that growth estimates for China are being revised up. And our sense is that growth will be the key focus for authorities in 2023 after 2022 GDP growth was a disappointing 3% compared to their target of 5.5%. So this will be underpinned in large parts by a whole lot of pent-up demand. There is a surge in savings in the world's second largest economy. About 1.4 billion consumers are just waiting to spend, after years of being locked down. And at the same time, government stimulus will also likely support consumption as well as investment demand. Just before the Lunar New Year holidays, the People's Bank of China added close to 2 trillion yuan of cash via open market operations, as you can see in this chart on the right-hand side. That was more than 9 times the size of the previous week's injection. So while these numbers may ease a little bit after the holiday, I think it's safe to assume that with this kind of a focus on growth, the People's Bank of China will guarantee sufficient liquidity in the system. And what is really important to note here is that China reopening also means further easing of the strains that we have seen earlier in the manufacturing supply chains. So some may argue that China's reopening may actually be deflationary. But our sense is that with the surge in demand from reopening, that is likely to be bigger than the potential relief that we are going to see because of the surge in supply. And the reason for that is that while Chinese authorities allowed demand to really slump with their zero COVID policies, there was still a clear focus to prevent disruption to production and to supply chains. So the net benefit, in our sense, from those easing of supply chain strains would potentially be lower than the overall negative impact because of the rise in demand. There are also some arguments that say that excess savings of Chinese consumers are more limited because of the losses that they've seen in the real estate sector compared to the excess savings we had in US and Europe after the reopening. But again, I would argue that policy stimulus in China is also in a very different place from the US or the Europe. China is still easing, while US and Europe were broadly tightening policies as the pent-up demand was unleashed after the reopening. So what does that mean for you? For once, I think it means that even a threat of a new leg of inflation could keep central banks away from pivoting too soon in the current cycle. The Fed specifically, it also has memories of the 1970s when it pivoted 3 times only to see inflation coming back stronger and higher. And they finally had to raise rates to 12% before they could really cap those price pressures. With the China situation being a little bit of a wild card at this moment, we are actually even more convinced now that inflation will not come back to 2% or even 3% levels, but instead it might settle around a 4% mark, and that the Fed will not cut rates this year. So while the China reopening excitement is boosting the markets for now, we think that investors should stay prudent and still keep their portfolios inflation-proof, not adding a lot of risk. Value plays, such as those in energy or in consumer staples, along with some exposure to bonds and gold, as well as non-US stocks as well, could provide a good diversification. Well, that is all for today. We hope you enjoyed this video and we wish you great success in your trading and investing journeys. And stay tuned for more macro insights from us here at Saxo.